But Mihir Vora is with us now, Chief Investment Officer at Trust Mutual Fund. He's with us in our studios. Mihir, good to have you with us here, as always. Thanks very much for your time.
Always a pleasure.
There's a new fund offering which Trust is coming up with. We'll talk about that. It's on the small cap side. But since we have you, just thoughts on markets, Mihir. Is this just a bit of a pause that we're seeing as far as large caps are concerned in India? And generally, the outlook looks pretty positive. US is making new highs. Incrementally, if anything, there is positivity in China, which is used to be the other big growth driver. So global is holding up better than usual. What's your sense?
Absolutely. The domestic situation is fine. You know, we're talking about 6.5 to 7.2%. RBI says 7.2. Consensus is 6.5 to 7% GDP growth. So that's I think holding up. The US domestic economy also has been quite resilient, so to say. But in general, if you see the pressures in the last few weeks have been on the debate in the West, between inflation and growth. And inflation has been creeping up from time to time. So you see these bouts where there is some fear of tightening. But my broad picture, or big picture, is that they have no choice but to keep interest rates low and keep printing away. Because the way the refinancing is coming up in the next 2.5 years for the US debt maturities, they have no chance of refinancing it if they don't keep liquidity easy and interest rates low. So I think structurally, we will see higher inflation because of printing, but that will lead to higher asset prices. That's the big call.
So it's a positive environment. It's a risk-on environment.
It's a risky risk-on environment, so to say, because you are actually depending, and it's going to happen, on a lot of money printing happening. It's a bad time to be poor because inflation hits the poor the most, and that's the situation globally, but that's the way things are. So assets will go up, whether it's stocks or real estate or gold, because of money printing.
Okay, risky, risk-on environment for the globe. What about India per se? And it's a tough time to be poor, right? Inflation hurts. So what about consumer durable names? Talk about the sector outlook from here.
See, India is different, right? For us, the situation is very different. Our demographics are far different from the rest of the world, even from compared to China, etc. So I don't think for us a 5% inflation is something new. We are used to it, and there is a difference between a 4% inflation with a 2% GDP growth, which is probably the case in the US, and 0% in Europe, and 7% GDP growth and 5% inflation. You can absorb that, because income levels keep rising, etc. So for India, things are different. We are not going to see downgrades in GDP growth.
Okay, and what's the overall call for Indian equities from here on over the next 3 to 6 months? Because earnings hasn't been very exciting.
I think it's going to be a stock pickers market. The global backdrop, as I told you, is going to be easy liquidity. So I don't think there's a risk of that. So FII flows as well as domestic flows should continue to hold up the market. The results season will be, sector specific, stock specific. I don't think people are expecting big numbers from the large caps in terms of, probably we are talking about single digit earnings growth. But in the bigger universe, there are lots of exciting stock picks. So India, I think, is becoming a broader market than what it was before. So to that extent, the sentiment should continue to hold tight.
Well, the sentiment is telling you it, right? Mihir, we had $5 billion of selling from the FIs in 5 sessions. We're talking about earnings growth for this quarter of 2 to 3%, and then a pickup in the second half of the year. And the market refuses to correct 5-6% as well. That's telling you the kind of money that's waiting in the sidelines domestically. But you tell us, y'all are looking to tap the small cap space. You'll have an NFO that's opening up. One would, people argue small caps are expensive. We say that Nifty is trading at X and small cap is trading at 25-30% premium. But you're still coming out with an NFO. Tell us how you're positioning this and few more details.
Absolutely. So part of the answer is in your question itself. When you said the earnings are likely to be, say, single digit, that's probably for the large companies at an aggregate level.
Yes.
But if I just do a cutoff of 2,000 crores, there are 1,100 companies of a market cap of more than 2,000 crores. The market's very wide now.
Yes.
India is a stock picker's paradise, I would say. So even if you remove the top 250, which is large and mid, 100 large, 150 mid, there are still 850 companies to choose from with a market cap of more than 2,000. And of course, we can go below 2,000 also. So when you're saying expensive, small caps are expensive, I don't think it means that 1,000 companies are expensive. Probably
a part of the market.
A part of the market is expensive, frothy, and probably the extremely micro caps, SME segment. But if you look at the structural change in the market, 10 years, 15 years ago, the top 100 companies used to comprise of about 80% of the market cap. Today, it's about 60%, right? So it's no longer a concentrated market as it was before. It's broadened a lot, you know. 4 years ago, there were 200 small caps or 220 small caps with a market cap of more than 2,000 crores, the way I use the cutoff. Today, there are more than 800 such stocks, right? The largest small cap used to be about 7,000 crores. Today, it's about 30,000 crores. The 251st stock, as we say, you know, it's about around 30,000 crores. So, number of stocks wise, size of the small cap universe, you talk about market, broadly speaking, we are about 450 lakh crores market cap, right? 90 lakh crore out of that, so more than $1 trillion is small caps. And another 90 lakh is approximately, I'm just rounding off the numbers, mid caps. Right? When we talk about that 40% being mid and small, it's 90 lakh crores each. You know, the size of the universe itself is quite large. So when we are talking about the small cap space, you know, it's a wide canvas.
It's a stock pickers, this thing. But as Nigel was asking, the question is about timing. You know, there are periods when, for example, 2018, right? I mean, we only found out in hindsight that it just topped out. Markets didn't go anywhere.
Absolutely.
I don't know why, but it happened. It happened. Maybe excesses or whatever. You think you don't think there's a timing issue here at all, or you think it's okay?
My comfort comes from the fact that the markets have not been completely irrational. So, for example, we still like chemical sector, right? But if you see chemical stocks, they have corrected quite a lot in the last 1.5 years. I'm not talking about just 2 months. I'm talking about 1.5 years of corrections in chemical stocks, 1.5 years of correction in banking stocks. A lot of correction in defense has happened in the last couple of months. So it's not like everything is trading at all-time highs, right? And if we still believe in the structural stories in some of these segments, then valuations can make sense. So, as I said, the canvas is so large, we are talking about 800 stocks, 1,000 stocks, that there will be stock picks available, which we are confident of. And the good thing about small caps is that it fits in perfectly with our investment philosophy of terminal value investing. Because all the things that we talked about, you know, remember during the NFO time, the previous NFOs about physical asset creation, about financialization of savings, about premium consumption, etc. A lot of these themes, frankly, are available only in small caps. So if you want to participate in so many of these high growth themes in India, you have no choice. 90% of the choice, 80% of the choices in terms of number of stocks are in small caps only. For example, if you want to buy a hotel stock, it's doing so well, right? The sector is doing so well. There's no large cap. Well, you get at least 10, 20 options in mid cap. Consumer durables you talked about, right? There is no large cap consumer durable. The only options are mid and small cap. So exposure to high growth sectors can only be there in some cases through or predominantly through small cap.
And also there are so many niche sectors, industries which feed into bigger industries where the exposure you can only get through some of those.
The other thing that has changed structurally is that earlier mostly small caps were ancillaries to large caps. Now small caps have their own segments. For example, wealth managers. I don't think they are ancillary to anything, right? Asset AMCs or broking companies, they're not ancillary to any large cap. They are standalone segments in themselves. So all these themes can be accessed only to mid or small caps.
Should we assume these are sectors you like?
Absolutely. we have laid it out in our presentation.
So tell us the sectors that you like, right? List them out, the top 5 sectors that you like right now.
We talked about the broad themes. So first is premium consumption. So in all segments of consumption, the premium segments are doing very well. So whether it's in real estate, whether it's in consumer durables, whether it's in, for example, gems and jewelry, those kind of segments will cars, two-wheelers, in all those cases, the higher end consumption is growing at a faster rate. The size may be small, but the growth rates are higher in that. Financialization savings, right? So we are talking about all the non-lenders. Lenders are usual stuff, but non-lenders are where the higher growth rates are. For example, when you talk about insurance, asset management, wealth management, broking, capital markets, the depositories, etc. So those segments will grow faster. Physical asset creation, we all talked about manufacturing, real estate, construction, infrastructure, those segments. So those are the themes which we really will drive the economy if we are to grow at 7% or more than 7%. And of course, our favorite segment, which is the new age companies using new business models.
Okay, all right. Quick word on cement before we let you go, because that's the sector that does well in the second half of the year, and the first half has been a washout. Whether you talk about elections, you talk about the monsoon, seasonally weak, but the first half has been a washout. So just leading into the next discussion, your view on the cement stocks?
See, I'm a real, what do you say, structural bear on commodities, because our investment philosophy is long-term growth and visibility of growth, and commodities like cement, etc., are too cyclical in nature. While there may be supply, demand, and seasonal opportunities available, structurally, they are commodities, and beyond a point, wealth creation it can happen only through some barriers, entry barriers, etc. So, in my view, cement is more of a trading segment, and we don't consider it as a long-term structural play.
Okay, all right, got that, Mihir. And I think with regard to this commodity segment, you rather play segments like, I think pipes or something like that is what you'll have been bullish on in the past. So you don't play the commodity, but maybe where it gets used and where there is an end use of it, like I think the water theme and various other oil and gas themes. Thanks a lot, Mihir, for joining in.
Always
and
a pleasure.
All the best for the NFO. We look forward to chatting up with you post the closure as well.
Thank you so much.